Hello, I'm Mark and welcome to Little Known Stocks, the show where I try to prove that being boring and doing your research will make you money. Now, before I start the video, if I could ask if you like it, not now, but if you like it, please like and subscribe. It really helps me out with the YouTube algorithm and find new people to watch the videos. So let's get started. Workhorse, who are they? So who are Workhorse? Well, they are a delivery vehicle manufacturer and they build these C650 vehicles and a slightly bigger version, this C1000 vehicle. Large capacity, they say built specifically for last mile delivery, and these are EVs, so electric vehicles. But more than that, they also are developing this Horsefly technology. So you may have seen demonstrations of this through UPS and Amazon, and it's worth noting that UPS, actually a huge company, have trialed the Horsefly, so they may be a future potential customer, which is very exciting. Not only that, but there's this Metron technology where you can control a large number of drones or even potentially a fleet from your phone. So that's exciting technology as well. And they're talking about revolutionizing the delivery industry. So really nice, a lot of good potential there in that industry. But what we really need to understand is the history of the stock. So we're at 718 at the moment. Our 52-week high was 42.96. So we've seen a massive plummet. And what we need to understand is this drop right here and the run up before that and why that was happening. So very simply put, Workhorse were bidding for a contract with the USPS, the United States Postal Service, and they lost that contract. And overnight, 2 billion was wiped off their share, their market cap. But in times of stress in the stock market, if you're banking on a single coin flip like this, often you decline too far and there's opportunity in the market. So I'm going to go ahead straight away and say that I don't like this stock at the moment, and I'm going to go ahead straight away, unlike my normal videos where I try to give a balanced opinion and mixed information. I'm going to go ahead and say two things, major things that I think really are holding this company back at the moment and that make me scared for the future. I'll then go on to explain why there's room for optimism, and certainly this company could have a bright future ahead of it. It's at a very, very low market cap versus its high at the moment. So if we look at the high, the market cap was astronomical. We've come down to 800, I believe, $880 million at the moment. We've knocked 85% off the high of the market caps. So I do think 885 million for a vehicle manufacturer that's already started producing vehicles could potentially be a really good deal. But there are two massive issues that I think need to be overcome first, and I'll be looking for them in the next quarterly report and potentially the one after to see whether this is a stock worth buying or whether it's really fearful and we need to stay away from it in the longer run. So the first reason why I can't buy Workhorse at the moment is their unproven supply chain. And I work in a supply chain, so this is an area that I know about. So chip shortages are making the news at the moment, and we've got an article here talking about Ford and how they're struggling. Think about if you're Ford and you're unable to get the components that you need to make vehicles, not just electric vehicles, but vehicles. And then think about if you're making 30 vehicles a quarter versus however many 100,000 vehicles Ford are making. And having worked for a large company in procurement, I can say that when a supplier doesn't want to send you something, no matter how hard you shout, even if you're one of the big guys, it is very, very difficult to get them to do what you want. So what I am pleased to see is that Workhorse are partnering with Coulomb Solutions. So they go on to say that Coulomb power over 330 commercial electric vehicles at the moment, that they are the largest manufacturer of commercial electric vehicles. But again, if you're the largest and you're talking to the smallest, probably Workhorse are very, very far down their list of priorities to supply. So it's a massive risk going forward, and one that I will need to see proof that they can fix before I buy into the stock. So it's important that we put in context how many vehicles that Workhorse have produced. So they produced a total of 38 C-Series vehicles year to date, and that was published on May the 10th, so really very, very few. And I'm just going to play you a quick clip where they talk about the logistics of the year and how many vehicles they expect to produce across a year.
Curious if you could give us a real-time update on what production looks like, and I guess how we should be thinking about the ramp to march towards that 1,000 vehicle production as we kind of move through the year.
Greg, this is Steve, so thank you for the question. So production's going on right now, and I would think of the ramp from a standpoint of, and the caveat is the supplier and logistical issues that are going on both now and probably even going in the future of the rest of this year, is that if you look at the 1,000, I think you could probably break it down into percentages of 10% of the 1,000 being in the second quarter, 30% in the third quarter, and then 60% in the fourth quarter.
Okay, and then just touching on that a little bit, when you talk about issues in the supply chain, I mean, clearly they've been well publicized. What should we be looking for as kind of the year plays out? You know, like what should we be thinking about this summer or in the early fall to think about the potential hiccups in that ramp?
I think what we've experienced for the most part has been less kind of some parts being short, but more the logistical issues of actually receiving them on time. You know, so I think it could be anything, you know, and I think all production companies are really experiencing the same thing as we are, is it could be any part that kind of comes up and is short or is not received on time. So, and, you know, any part can slow down the line. So it's hard to predict what it could be going forward. So, but we're going forward, and I think that's why we're kind of stepping into the second quarter being 10%, just to kind of see how some of these supply and logistical issues kind of play out.
So just to break that down, they're saying that they want to produce 1,000 vehicles this year, and that's their guidance. And they want to produce 10% in Q2, 20% in Q3, and 60% in Q4. This earnings report was published on May the 10th, and they reported 38 vehicles. So in my mind, they're already behind on Q2 unless they have a really, really significant ramp up. So very worried about that. The other thing that doesn't give me confidence is they keep talking about their partnerships. So they talked about partnering with Prefix. They constantly bring up Hitachi and their manufacturing excellence. They're really relying very heavily on these other companies to ramp up and improve their manufacturing processes. And it doesn't really seem like they themselves are manufacturing experts or capable of producing the volume that they need. But that remains to be seen. And if they have a great Q2 and Q3, then I will change my opinion and potentially, if the price is still right, look at investing in this stock. The second reason I can't invest in this stock at this point is the balance sheet. Now, the cost of sales are over 6 million. Net sales 521,000. Now I worked that out. I think from the call I could also discern as well that I think they sold 10 vehicles in the first quarter, although I can't be sure of that. There are a few different numbers thrown about on the call. So I'm just going to play you another clip where they go in more detail on this, and then I'll explain it and explain why I think it's still very, very risky.
We look at the numbers you disclosed this quarter. ASP roughly mid-80s, and looking at COGS per truck, the roughly 25 that you produced in the quarter, something around $250,000 a truck. Now we know that this is really just the startup phase, and there's a lot of extra man hours and engineering content in that cost of goods sold. Can you maybe talk us through the fixed and variable components in there? What exactly is the materials content opportunity? And given that you have a new supplier coming online for the batteries, is this going to be a large part of the expected progress on the margin front over the next couple quarters?
Yeah, Craig, thanks for the question. So yeah, the COGS is high, like you said, and higher than we would want at this point in time as well too. So, but there are things that we are doing on the battery front that will be something that will be lower cost going forward. We have our frame, we have lower costs going forward. But as I mentioned, I think in the first quarter, the gross margin is going to be negative all this year. and it's going to be high negative all this year. And it is typically for any manufacturing company that is starting to go from basically zero to any kind of volume. So the expectation should be a pretty high negative margin all year.
But can you talk us through maybe the variable contribution, sort of backing out the extra man hours on trucks? I mean, if you weren't starting and if you were just, say, running at a reasonable rate today, is your material supply chain priced where you would be generating positive margins, or do you need the benefit of volume to get that out of your supply chain to achieve the positive margins that I know you're working so hard to achieve?
Yeah, so Craig, where we're standing is our BOM. At the end of the day, that's the major cost. It's probably 95% of our cost of goods sold, or will be kind of going forward in a target standpoint. So it's the BOM where we're at, and we need material savings, and we need the volume discounts. So we're at that stage in our supply life where we're ordering in small volumes. We're not getting those volume discounts. We're not getting payment terms like we would like yet. We need to line up the suppliers and have feedback quality. We're doing all that, but we're doing that at the same time as we're trying to produce trucks.
So a lot to break down there. I don't necessarily mind that their margin's negative. That's not the point of this. I don't mind that it's going to be negative all year, even if it's going to be significantly negative this year. What I mind about is the fact that they talk about a lot of their costs are the COGS, so the cost of goods sold, and a lot of it's in their BOM, so the bill of materials, and that means what it costs for all the components to build the trucks. I was expecting him to say that the factory overheads, the cost of running a factory, the cost of all the labour was the expensive part, and as they scaled up, that would become cheaper. But he spoke about components, and let me tell you, okay, they're making a very small number. I expect them to be paying through the roof for batteries, for tyres, for anything that goes on the vehicle when they're buying 10, 20 of each. But let me tell you, buying 10 and buying 1,000, the price doesn't come down to 1/5. You need to scale up hugely in order to get that sort of leverage and that sort of efficiency. So that's what's really concerning me. And I think if the deficit continues to be huge over the year and doesn't improve, then I think the stock will fall further, and I think you may be able to pick up later on in the year even well below $7 where they're currently at. But we'll see. So a third risk, but a lesser one in my opinion, is that Workhorse at the moment have two main customers. They have the Pritchard Group, who again I think are selling on their fleet, and they're trying to generate customers as well. They had 500 orders of those, and I believe they're fulfilling that as time goes on. Pritchard are looking for new buyers, and they're trying to expand the Workhorse fleet. The second one being Pride, a Canadian company who have ordered 6,320, so really massive customer, and I think we know the backlog to be around 8,000 or so. So it's really good that they've got a pipeline of orders. That is really good. Obviously, you don't want a company making what they can't sell. Clearly, these two customers are pretty confident in the product, but we need to see further orders and an expansion of the customer base. If Pride were to pull out and didn't want these 6,000 vehicles anymore, that would be devastating for Workhorse, and you want to avoid risk like that. So I'm conflicted about this, but they are sponsoring a Major League Soccer team. So FC Cincinnati, they've named a stadium landmark after them, one of the entrances. They're also putting their charging stations out there, which we'll talk about in a little while. So I like this because it's looking for new business, and they should be looking for new business. But I also think when you've got such a heavy deficit, should you be spending money on sponsorship like this? But certainly they need to expand their customer base. So a worthwhile investment, I think, overall. So the last thing is Ark Invest. Now, you really shouldn't be worried about what hedge funds are doing. They're going to do what they're going to do. And Ark Invest have always said that they will, if the market dips, they will consolidate their positions. So sell out of some of their riskier positions and consolidate into some of their more sure thing positions. But Ark Invest have been selling heavily. The only reason why this matters is because other people pay attention. And certainly last year, Ark Invest were one of the darling funds out there that a lot of retail investors were copying the trades of, and that's one of the reasons why the Workhorse price was driven significantly higher. if ARK Investor selling, you may see people follow them, but again, as retail investors, we shouldn't be looking at what the big hedge funds are doing. We should be trying to assess the value of the stocks. So let's talk about some positives now. Workhorse have certainly some tax advantages. Firstly, if you purchase a vehicle in California, I think you get the first $45,000 off a $50,000 vehicle if you're going to use it for a work fleet. So people are encouraged to buy a first vehicle, which is great. And all of that money goes into Workhorse's pocket, so that's really strong. They obviously have very good emission standards. They're a zero emission vehicle. That gives them some advantages in terms of credits, so zero emission vehicle credits, which Workhorse received 2.07 per C1000 vehicles, so they can sell that on. They're worth about $3,000 each. So that's substantial if you're getting one of those per vehicle. That will certainly improve their margins. Additionally, they do own Lordstown Motors, so this is a positive and a negative. Certainly they've had they own 10% of that, so certainly they've had some positive share growth as the Lordstown news has come through positively. But on the flip side, they've also shared in the pain when Lordstown has declined somewhat. So if we look at the balance sheet for the last earnings call, you can see this other loss income, 136 million. That is share depreciation for Lordstown. So the share price has dropped significantly. Not something to worry about. It could be a positive in the future if Lordstown turn out to be a successful company in their own right. And lastly is the focus on drones. So I haven't spoken about this much, but Workhorse really are part of a two-piece strategy. The first piece of the strategy really is the electric vehicle, obviously, but then you have the drone that goes alongside it. And they've just announced John Graber as president of its aerospace operations. It seems that's really ramping up, and they sold their first electric drone. So the drone comes in combination with the trucks, but also can be bought separately. And this is something that they seem to be really, really far ahead of the competition on. And it's very exciting. They've got a lot of very high standards. They've passed some Aero Division and aerospace accreditations recently. And really they seem to be moving forward very quickly with this. So this could be a really substantial business in its own right if they can upscale it. Not only that, but they mentioned there's a lack of competition in this particular space at the moment. I think they were talking about drone and the EV market for deliveries and last stage deliveries. They've got the app, which I think is really forward thinking. And if they can deliver on the manufacturing, I think this could be a really successful business model going forward. They do seem to be very far ahead of the competition. And the important thing is that they are starting to manufacture, which a lot of their competitors aren't. So that's really good news. We just need to see the ramp up, and we need to see sustained growth step by step, not stopping and starting in a manufacturing process. We want to see some consistency and some ramp up over time.
As you know, we have been really well focused on expanding, our reach through these dealer network channels and those things, so that we're not putting all our eggs in the one basket scenario, as you know, especially with all of the competition that's coming out and being introduced. But I would tell you that, in our particular segment with 1,000 cube vehicle and even larger, right? I won't say we're the lone player there, but we are clearly leading the way in terms of not just vehicles on the road with millions of miles and now the second generation ready to take to the roads, but we're also demonstrating, the integration of our other technology, whether that's software related and or drone technology, which continues to differentiate us.
Lastly, they did say that they expect to start to be profitable in 2022, and they mentioned potentially around the middle of 2022. It seems a very, very long way from now, but if that starts to be the case and we do see real potential in that economies of scale model that they're hoping for, then I will certainly be looking again at this stock in the near future. So as I say, the price to sales ratio of 400 is just astronomical, and at this stage of the company, I just can't invest, but I think that they could be a really great company going forward. So one of the great values I really get out of this channel is hearing opposing views, and that really adds to my own knowledge of the stock. So if you do have any opposing views, please let me know down in the comments below. If you like the video, please like, and I would be very appreciated if you did to subscribe. Otherwise, I've really enjoyed making the video. Thank you very much for watching, and have a good day.